On unit 3 on applied corporate finance, and this unit is going to measure the investment returns for any project essentially. So far we have learnt about the discount rates that we are going to use. Now what to discount is basically going to come here. So essentially in our equation of cash flow divided by 1 plus r, the 1 plus r part we have already seen, right? Now in this particular session we're going to look at what is the cash flow part and how do we arrive at that and how do we really discount that, what kind of returns are generated. We will also look at details and revisit our NPV versus IRR rules to grasp as to when does NPV work better and when does IRR work better, for what kind of projects is NPV better and for what kind of projects is IRR better, right? As we go along, we'll start kind of discussing some of these data points, which are cash flows versus earnings. What do we mean by a project? What and how do we measure returns? What are the multiple ways we can measure returns? Various investment decision rules. When do we use NPV? When do we use IRR? Approaches to investment analysis and mutually exclusive projects. So as we go along, these terms will become clearer and clearer. Right. Let's first focus on the idea that we are looking at here, which is the return should reflect the magnitude and timing of the cash flows as well as all side effects, right? Which means if you're taking a project or if you're taking an endeavor, whatever additional ancillary impacts are happening because of that have to be taken into account, right? We have learned a little bit of this earlier in our financial management portion, which is if you take a project and that results in loss of revenue and existing business, then essentially that has to be taken into account here, right? So that's what we're going to try and do. We're going to look at live examples in this case and then try and apply that to the learning that we have in terms of corporate finance, right? The first concept that we need to understand is the cash flow versus accounting earnings basis, and what is it that we should ideally be using in terms of calculation of our investment returns, right? Remember that accounting earnings are measured on the basis of accrual, right? Which means when revenue is booked, it's kind of accounted regardless of whether it has come in or not come in, right? Similarly, when costs are booked, they're accounted regardless of whether they have come in or not come in. Revenues are booked when the goods and services are sold and not when the money is received. Costs are similarly booked for those revenues and not when the money is paid. Correct? Now, when you look at cash flows on the other hand, that's something else. We'll come to that in a moment. We also need to understand what is operating versus capital expenditure. Only expenses associated with creating revenue in the current period should be treated as operating expenses. What would be examples of this? Salary is an example of this. Electricity cost is an example of this, right? Expenses that create revenue over several periods, essentially, they should be written off over multiple periods as depreciation or amortization, right? Examples of this would be any kind of capital expenditure that you're doing, any kind of license expenditure that you're doing. So for example, telecom companies go and take a license. So essentially that is amortized over a period of time. License being an intangible asset will get amortized over a period of time. Correct? Now that is an important construct in our overall understanding of what to classify as capital expenditure and what to classify as operating expenditure. When you look at cash flow from accounting earnings, you have to add back any non-cash expenditures, which is depreciation or amortization that you have already cut out, right? You have to subtract out cash flows not expensed, right? That is essentially capital expenditures. These are not expensed that year, remember? So you have to remove the capital expenditure, and we have to make changes by looking at cash, revenue and expenses instead of the accounted revenues and expenses, and that is all the changes that will come on account of working capital. Correct?